It's been anything but a quiet start to the year. Consensus expected a Goldilocks outcome, lower interest rates, solid growth, and a continuation of market trends, perhaps still remembering the recessionary calls from 2 years back. We see this year panning out as a tale of two narratives. Inflationary concerns now because growth is good, giving way to outright concerns on growth itself. And we expect the first narrative to be shorter-lived. And it's not just economic growth we are concerned with. A market price to perfection with earnings expectations unrealistic and bond spreads at historic lows, it won't take a lot to tip the balance. But then surprises come when and where they're least expected to. And here are some. A Eurozone recession, sharper deterioration in consumption and labor markets, and the Fed cutting more than 50 basis points are above average macro probabilities. S&P earnings missing expectations is another possible surprise that has a higher probability, as well as a sustained rally in oil and industrial commodities as China recovers. So how do we position? In equities, we stay with growth for now, but are increasing hedges with a forward view tilting towards defensives. Geographically, we like China ahead of India. Corporate bonds aren't attractive and treasuries are better than their corporate counterparts. Amongst alternatives, long-short, macro, relative value arbitrage, and merger arbitrage strategies are preferred.
The consensus is bullish, with expectations bunched around 6,500 to 6,700 for the S&P. And this is on top of the 75% cumulative gain seen over the past 2 years. While this has riled many a bear, the question is whether the bulls will continue to dominate. The bulls argue, on one hand, that Gen AI revolution is currently upon us and there are no signs of a slowdown yet. The Mag 7 is once again likely to deliver strong earnings growth this year. And lastly, the lack of a specific catalyst at this point in time can help the market stay afloat. The bearish argument, on the other hand, stems from skepticism on monetizing all the capex spent on Gen AI. Other bearish arguments include elevated and probably unrealistic earnings expectations, uncertainty and volatility associated with the Trump 2.0 campaign, and potential risks of the labor market tipping over. With all these uncertainties, growth visibility will command a premium. Large cap growth stocks remain preferred, combined with tactical, dynamic hedges to navigate drawdowns. Globally, we see macroeconomic challenges continuing to plague the Eurozone and the UK, which should have a detrimental impact on domestic markets. Japanese stocks could have a tough year as well, with the BOJ having recently initiated a hiking cycle and domestic consumption already feeling its impact. Within EMs, China and India are likely to see diverging prospects. We expect Indian equities to underperform, given the elevated valuations and demanding earnings expectations, while China can potentially benefit from extremely subdued expectations, which have pushed valuations to significantly depressed levels.
Fixed income in 2025 is akin to navigating a storm. The rise in yields in the US is likely to continue, driven by stronger than expected economic data prints and anticipated policy measures by Trump 2.0. However, we also see this tapering and reversing towards the end of the year, courtesy of pronounced economic slowdown. Hence, we maintain a neutral view on duration that's up to 5 years, with the caveat that we would gradually add duration as yields peak. This spike also means that we are neutral on treasuries, currently with the likelihood of being overweight towards the later part of the year. Within the corporate credit space, we are underweight IG and high-yield corporates, owing to near all-time low spreads. These are likely to widen as the economy slows down and as refinancing needs more supply, particularly in the IG space. We will, however, be inclined to add select corporate credits later this year, depending on the quantum of spread widening. Now, turning to opportunities in 2025, high-yield credits. Spreads widening is likely to be partially offset by lower refinancing needs in that space. We also prefer European AT1 issuers in USD, especially the ones with equity conversion clause. This is largely owing to the still attractive spreads in our opinion, given their quality. EMBB corporates is another area where we see an opportunity given the attractive yields they offer, in excess of 7% currently. The distress ratio in the US is at 5.7%, with default rates inching up to 3.1% in December. This would continue to offer opportunities to generate alpha in the distressed debt segment.
As we enter 2025, global markets face increased directional risks driven by growth uncertainties as well as policy shifts. In this environment, we continue to view hedge funds as portfolio diversifiers within the client's portfolio. For managers trading in public market assets like bonds and equities, we maintain an underweight position in long-only strategies. This is because of their traditionally high beta exposure and sensitivity to potential broad market corrections. Persistent growth concerns as well as market volatility could significantly impact these strategies, leading to negative mark-to-market impact. On the flip side, we favor long-short strategies, benefiting from domain expertise, as well as expected wider dispersion in terms of asset price performance. This environment should allow long-short managers to capture alpha from both sides of the books across sectors. A low beta as well as low correlation is also welcome in diversifying the overall portfolio in that regard. Private credit as an asset class remains compelling with its contractual interest payments as well as tailored loan structures, especially in direct lending as well as infrastructure financing, with the caveat that renewables might take a back seat this year amidst policy direction changes. As always, liquidity considerations of the fund vehicles, loan book transparency, and growing use of payment-in-kind loans, especially in the US, highlight the need for rigorous due diligence of the manager. Macro and relative value managers are also positioned to capitalize on global dislocations, while special situation strategies can unlock value through distressed debt, event-driven and merger arbitrage opportunities. A recent trend would be the rise of actively managed ETFs, and that is something to also keep a watch on, with advantages like lower expense ratios compared to traditional hedge funds, enhanced liquidity, as well as trading flexibility. Active ETFs offer a compelling complement to traditional as well as alternative strategies. An example of an active ETF would be an index tracking strategy overlaid with some covered call option selling to generate income and lower downside volatility. So in summary, a strategic overweight in long-short, macro, relative value, and private credit strategies, coupled with selective exposure to active ETFs, positions portfolios to better navigate the complexities of 2025.
The last 3 years have been great for directional positioning. Bearish in 2022, bullish equities, and bearish treasuries in 2023 and 24. This year promises to be uncertain and volatile, and not least due to Trump 2.0. While this is a risk, we also see an opportunity with a premium on being nimble as we transition from growth to growth concerns.